Imagine a fire that you literally just cannot put out.
Oh yeah, the ultimate nightmare scenario.
Right, like you spray water on it and it doesn't extinguish. In some cases, water can actually make it worse.
Which is terrifying.
Completely. The fire is basically creating its own oxygen as it burns, feeding itself in this, unstoppable chain reaction. And that is the reality of a lithium-ion battery experiencing what engineers call thermal runaway.
Yeah, that's the industry term.
It is the absolute nightmare scenario for anyone building our modern energy infrastructure, and frankly, it's exactly why the world is desperately searching for a fireproof alternative right now.
It's a massive physical constraint on our digital ambitions.
Yeah.
We tend to think of the whole technology boom, particularly artificial intelligence, as this smooth, frictionless curve of progress. Like it all just lives completely in the cloud.
Just magical code floating in the air.
Exactly. But that cloud is heavy.
Yeah.
I mean, it requires millions of servers
Mhm.
housed in these gargantuan data centers, which, and this is the key, require absolutely staggering amounts of electricity.
The digital world is slamming headfirst into the physical world.
It really is.
And the collision is incredibly messy. Which honestly brings us perfectly to our mission for today. Welcome to today's deep dive. For you listening, whether you are, actively tracking this AI boom, if you're trying to figure out the future of renewable energy, or if you're just kind of fascinated by the hidden physical infrastructure that actually makes your smartphone work, you are in the exact right place.
Absolutely.
Today, we are looking closely at EOS Energy Enterprises. They trade under the ticker EOSE, and we have a pretty thick stack of sources to go through today.
Lots of data on this one.
Yeah, we've got financial analyst notes, some really deep technical breakdowns on their proprietary tech, details on these massive recent joint ventures, and market sentiment data as of July 6, 2026. EOS is just such a fascinating case study because they are sitting directly at the intersection of three massive global trends. You've got the AI, energy crisis, grid modernization, and next-generation battery technology.
The perfect storm.
Right. But as you look through these sources, you realize very quickly that this is not a simple, clean success story.
Oh, not even close. Our mission today is to help you understand how a company with deeply negative margins, a company that has just been bleeding cash with a stock price that's been battered over the last year, might actually be in the middle of transforming into a multi-billion-dollar project financing powerhouse for the AI age.
It's a wild pivot.
It really is. Okay, let's unpack this. Before we get into the wild financial turbulence and, the survival maneuvers, we have to establish what EOS actually makes.
Right, the core tech.
Because if you just assume they are building slightly better lithium-ion batteries, like the ones in your phone, or an electric Tesla, you'd be completely wrong. Exactly. They're taking a fundamentally different chemical path. EOS is focused entirely on proprietary zinc-based battery technology, specifically what they call their Znith and Z3 battery modules.
Right. And the analyst notes highlight two huge factors here. First, these are made using non-precious earth materials, and they are entirely manufactured right here in the United States.
Which is huge for supply chain security.
Exactly. But the true game changer, the thing that makes them a viable business, is the chemistry itself. Recent independent safety testing just validated that these Z3 modules exhibit zero thermal runaway.
None at all.
No sustained fire, and absolutely no fire propagation to adjacent live modules.
We really have to pause and understand why that is happening, because it is the core of their entire business model.
Yeah, break down the chemistry for us.
So lithium-ion batteries use liquid electrolytes that are, they're highly flammable. If a cell gets too hot or, say, gets punctured, that liquid ignites, and the heat triggers the cells next to it. That's your thermal runaway.
The unstoppable fire.
Right. EOS's zinc batteries, however, they use a water-based electrolyte. So from a purely chemical and physical standpoint, they literally cannot catch fire.
Which brings me to an analogy I've been kind of kicking around. If we look at lithium-ion batteries, which are, let's be real, the undisputed absolute kings of the current market, they are basically high-performance sports cars.
I like that.
Right. They are incredibly fast to charge and discharge, they're super efficient, and they pack a massive punch into a very tiny footprint. But if you push a sports car too hard, or if it crashes, it explodes spectacularly.
Yeah, the margins for error are tiny.
Exactly. EOS's zinc battery, on the other hand, is a freight train. It is slower, it's physically heavier, it takes up a lot more space, but it is a heavy steel, completely fireproof freight train.
That is a highly accurate way to visualize the physical differences.
But I have to push back here.
Okay, let's hear it.
Is being a non-flammable freight train really enough of a competitive moat for a business to survive? I mean, lithium-ion has a massive, decades-long head start. They have global economies of scale. Billions of dollars have been spent to optimize that supply chain.
That's true. It's a juggernaut.
Right. So can EOS really survive against that juggernaut just by saying, hey, at least we don't catch on fire?
Well, what's fascinating here is that EOS isn't actually trying to race the sports car.
What do you mean?
They aren't trying to put a zinc battery in your laptop or your EV. They are competing in a completely different utility case. We're talking about long-duration storage.
Okay.
The need to discharge power steadily over 4 to 16+ hours. Lithium-ion is brilliant for quick bursts. Say you need a 1 or 2 hour discharge to manage a sudden spike in grid demand when everyone turns on their air conditioning at 5 p.m.
Right. The peak hour.
Exactly. But it becomes incredibly expensive and, frankly, volatile to string thousands of lithium batteries together to provide 12 or 16 hours of continuous baseload discharge.
Yeah. Because to get 16 hours of power, you just have to keep buying more and more of these expensive, highly flammable sports cars and parking them next to each other.
Precisely. And this is where the safety profile and the domestic sourcing become a massive regulatory moat. As power utilities try to build these gigawatt-scale storage facilities to balance the grid, they are facing intense, organized pushback from local communities.
Oh, NIMBYism. Not in my backyard.
Exactly. People do not want a sprawling field of chemical sports cars that might ignite built next to their neighborhoods or their schools or hospitals.
Which is fair, given the news.
Right. We've seen high-profile lithium battery fires globally that literally take days to burn out. So EOSE offers a utility company a safe, non-toxic, domestically sourced alternative that a local zoning board is actually willing to approve.
Which naturally leads us to why this matters right this exact second.
Right.
We have to talk about the macro tailwind, the AI power crisis.
This is the big one.
Yeah. We are seeing unprecedented surging electricity demand from artificial intelligence, high-performance computing, and all these massive new data center infrastructure builds. The physical power grid is just acutely constrained.
It is entirely bottlenecked. Look, tech giants want AI capabilities, but to train an AI model, you need vast server farms operating at maximum capacity.
Right. Yeah.
Those data centers draw unimaginable amounts of power, 24 hours a day, 7 days a week. It is a relentless draw on the grid.
Right.
At the exact same time, the power grids are transitioning to intermittent renewable energy, like solar and wind.
Right, and solar only works when the sun is shining. Wind only works when it's actually blowing.
Exactly.
Yeah.
So to balance that load, to capture massive amounts of solar energy during the day and legally guarantee you can feed it to a multi-billion-dollar AI data center all through the night, you absolutely must have safe, reliable, long-duration storage.
And the numbers in our sources reflect this desperate demand. EOS currently has a pipeline of approximately 16 gigawatt hours of long-duration energy storage projects.
Which is massive.
Huge. And of that, about 2.7 gigawatt hours represents what analysts are calling high-probability conversions. For context, just 1 gigawatt hour can power thousands of homes for an entire day. So we are talking about a massive amount of physical energy.
It is a staggering backlog of potential business.
Now, here's where it gets really interesting. In the analyst notes covering market sentiment, there's a huge speculative catalyst jumping out.
The rumor mill.
Yeah, exactly. There is a rumor circulating around a specific 1.2 gigawatt-hour chunk of EOS's pipeline that is currently marked as ready to sign. The speculation in the market is that this could be a mega contract with a hyperscale AI data center developer.
A huge player, in other words.
Right, someone who is specifically seeking non-lithium grid solutions to power their AI ambitions without taking on that massive fire risk.
You know, if we think about the broader market dynamics, that rumor makes perfect logical sense. The hyperscalers, those massive tech monopolies running the cloud, they've all made net zero carbon pledges.
Right, they want to be green.
They want green energy, but they demand baseload, always on reliability. If EOS can actually land a contract with a hyperscaler, it instantly validates their zinc technology on the global stage.
It's the ultimate stamp of approval.
It proves to the entire market that the freight train is exactly what the digital economy needs to keep growing.
Okay, so let me summarize where we are. The chemistry works, it's safe, it's domestically made, avoiding all those geopolitical supply chain issues.
Yep.
And the AI market is desperate for it. So my question is, why is the company struggling so much financially? Let's talk about the financial paradox in these sources, because honestly, my brain is breaking looking at these charts.
It is a brutal textbook case
Yeah.
of the pain of hardware scaling.
It is hypergrowth mixed with just a financial bloodbath. I'm looking at the revenue metrics here. In their most recent quarter, revenue hit roughly $57 million. That is an increase of nearly 450% year over year.
Right.
And if you look at their trailing 12-month revenue, they are growing at an eye-watering rate of over 700%.
Those are the kind of growth numbers you usually only see in, like, viral software companies,
Yeah.
not heavy in industrial manufacturing.
Exactly. But then you look at the margins, and it's a total disaster. For every dollar they make selling a battery, it currently costs them $2, sometimes $3 just to build the thing and run the company.
Yeah, it's rough.
Their gross and net margins are deeply, deeply negative. Their earnings per share is negative. I have to play the proxy for the listener here because this makes zero intuitive sense. How on earth can a company grow its top-line revenue by 700%, sell basically everything they can make, and still be losing that much money on every single battery? Is this just a bottomless money pit?
Well, it looks exactly like a money pit on paper.
Hmm?
But what you are looking at is what analysts call execution risk on negative margins.
Okay, break that down for me.
To understand how a business survives this, we have to look at the mechanics of commercializing a brand new physical technology. EOS is currently transitioning to their automated Z3 manufacturing line. You have to imagine it kind of like opening a massive state-of-the-art restaurant.
Okay, I like this. Walk me through the restaurant.
So when you build a massive commercial kitchen, your upfront fixed costs are astronomical. You have to sign a lease, you buy millions of dollars in industrial ovens, you source your raw ingredients, and you have to hire and train a huge staff.
Right, big upfront spend.
You are paying for all of that overhead every single month. Now, imagine if in your first few months, you only have the capacity to cook and sell 10 burgers a day.
Wow. Okay, so if I'm paying for a whole factory but only selling 10 burgers, mathematically, each burger is costing me like $1,000 to make.
Exactly. Every single battery currently rolling off EOS's initial manufacturing line is carrying a disproportionate massive share of those fixed factory costs. The only way out of that negative margin trap is to achieve economies of scale.
They just have to build more batteries faster.
They have to get the automated machines running perfectly so they can produce thousands of batteries a day. Once they do that, the fixed costs of the factory are spread out over thousands of units, bringing the cost of each individual battery down below the price they sell it for.
So it's basically a race against time. If they fail to execute on that manufacturing ramp up, they just continue bleeding cash on every unit until they go bankrupt.
That is the existential threat. And because of that severe cash burn, EOS was effectively staring over a financial cliff earlier this year.
They were running out of time.
They needed a massive lifeline to survive long enough to finish that factory and reach scale. Which brings us to the recent strategic maneuvers that have, honestly, completely rewritten this company's narrative.
Right, let's talk about Frontier Power USA, or FPUSA, because this is the lifeline.
This is exactly where the story shifts from a struggling, cash-burning hardware startup to a major infrastructure play.
Okay, on June 30, 2026, EOS announced a highly complex, massive capital injection. I'll try to break down the mechanics here so it makes sense.
Go for it.
First, they did a registered direct offering to a group called Hudson Bay Capital Management. This was for about 13.6 million shares and 6 million warrants. And warrants are basically just coupons that give the holder the right to buy more shares at a specific price later on.
Right.
So that move raised about $75 million in immediate cash. At the exact same time, they launched a $150 million rights offering.
Which is a whole different mechanism.
Yeah, a rights offering is essentially the company going to its existing shareholders and saying, hey, we are holding an exclusive presale. You have the right to buy new shares at a discount to help fund us.
And all of this complex financial engineering was specifically to fund EOS's contribution to this new joint venture,
Right.
FPUSA. We really have to look closely at who is sitting at the table in this joint venture. Hudson Bay didn't just buy discounted shares. They committed another $50 million directly into the FPUSA joint venture itself.
And then you have a massive player stepping in, Cerberus Capital Management. Cerberus is receiving Class A1 units in the joint venture tied to a commercial framework agreement.
So you've got serious heavyweights involved now.
Exactly. Add it all up, and the sources show an expected total equity investment of $375 million into this entity. But the key to this whole operation is a multiplier effect.
Yes, the leverage.
That $375 million in equity is expected to support over $1.5 billion in deployable project capital based on a 75% loan-to-value, or LTV, ratio.
If we connect this to the bigger picture, this maneuver is a masterstroke in corporate survival.
It really is.
Before this joint venture, EOS's balance sheet was viewed by the market as just a massive dilution liability. Investors knew the company was burning cash to build the factory. And to get cash, EOS would just have to keep printing and issuing new shares.
The classic death spiral of a cash-burning startup. You print shares, stock price drops, print more shares, stock drops further.
Precisely. But by bringing in Cerberus and Hudson Bay, they completely changed the narrative. They didn't just get cash to keep the lights on. They got Tier 1 institutional validation.
Smart money.
Yeah, these are incredibly sophisticated capital allocators who sent teams of engineers to look under the hood of the Z3 technology. They reviewed the factory plans, and they decided to back it with hundreds of millions of dollars.
Yeah.
Furthermore, that 75% LTV ratio you mentioned, that is the magic bullet.
Explain the LTV, because I think a lot of people gloss over what that actually means in the real world.
So, loan to value, or LTV, in this context is kind of like a mortgage for a power plant. It means major banks and lenders are willing to lend 75 cents for every dollar of equity used to build these specific energy projects.
Oh, wow. Okay.
You only get project financing at that massive scale if the conservative banks believe the underlying technology, the zinc batteries, will reliably work and generate revenue for the next 15 to 20 years.
They aren't taking a venture capital bet.
Right. They aren't financing EOS the startup. They are financing the concrete projects EOS is building. This transforms EOS into a project financing powerhouse.
Okay, so we've established the tech is safe, the AI market needs it desperately, and they just secured a $1.5 billion project financing lifeline.
Things are looking up.
So if everything is so great, let's look at how the stock market is actually pricing this reality today. Because looking at the chart, it is absolutely brutal.
Yeah, it's not pretty.
As of our sources on July 6th, EOSE is trading right around $5.20. It's down nearly 6% on the day. That is precariously close to its 52-week low of 4.37. And it's a massive, painful drop from the 52-week high of nearly $20 a share. For anyone who held this over the last year, I mean, they are down over 50%.
It has been a severe and punishing drawdown for any retail shareholder who believed in the technology early on.
Right. But there are some heavy twitches of life here. The 10-day average volume is massive, over 21 million shares trading hands.
That's a huge surge.
Yeah, that shows huge institutional repositioning. Big funds are swapping positions. The beta is also incredibly high at 2.68, meaning the stock is highly volatile and swings aggressively compared to the broader market. So what does this all mean for you as a listener, perhaps looking at this as a retail investor? Because to me, it looks like to get that $1.5 billion lifeline, they had to print so many new shares that the dilution is just crushing the stock price.
This raises an important question about market mechanics, and specifically the psychological toll of what analysts call permanent capital impairment.
Sounds intense.
It is. You are entirely correct about the dilution overhang. When a company issues a massive rights offering and sells millions of new shares and warrants to funds like Hudson Bay, the market instantly reprices the stock lower.
Because the company pie hasn't gotten any bigger, but it's suddenly been cut into millions of new, smaller slices. So everyone's existing slice is suddenly worth a lot less.
Exactly. And the analysts point out a very specific danger zone right now, the $5 psychological support level. Remember those warrants, the coupons we talked about?
Yeah.
They are tied to a strike price of around $5.48. If the stock drops below $5 and stays there, those warrants expire out of the money, meaning they are totally worthless to the institutions holding them.
And if that happens, what is the impact on the retail guy who has been, holding on for 2 years?
Well, that is where permanent capital impairment happens. It means the retail investor took all the pain of the dilution, they watched their slice of the pie shrink, but the stock price never recovered enough to give them the offsetting benefit of the new joint venture's success. It's the ultimate frustration. You were right about the technology, but you still lost money because of the financial mechanics. It is a high-stakes tightrope walk right now.
But to be fair to the sources, they also point out a major counterbalance, right? Like a potential light at the end of the tunnel that could clear this resistance.
Yes, there are two major upcoming catalysts. The sheer trading volume you mentioned. those 21 million shares, suggests the market is actively digesting this messy new reality. The bear case is that the factory scale-up fails and they keep burning cash.
Right.
But the bull case relies on the impending expiration of that rights offering. Once the rights offering completely closes out, the immediate fear of more share printing lifts. The overhang goes away.
And there's also the final regulatory hurdle for the joint venture, too.
Correct. The closing of the FPUSA joint venture is currently waiting on final consent from the Department of Energy.
The DOE.
Yes, and the DOE cares deeply about this because creating a domestic, non-lithium battery supply chain is a massive geopolitical priority for the United States.
So if the rights offering clears and the DOE formally stamps their approval on the joint venture, that massive dilution cloud could just evaporate. The market might suddenly stop looking at the short-term share printing and start pricing in the fact that this company now has a $1.5 billion war chest to deploy physical infrastructure.
That is the exact flip in narrative that the institutional bulls are betting on. And because the beta is so high, if that narrative shift happens, the upward price action could be incredibly aggressive.
All right, let's bring this all together for our final synthesis. Based on all the analyst sources we reviewed today, EOS Energy sits at a 7 out of 10 bullish score.
It's a strong rating, considering the turbulence.
Yeah. It is essentially a pure play on the surging global demand for safe, domestic, long-duration energy storage, a demand that is being almost entirely driven by the insatiable power needs of AI data centers and the agent requirement for grid modernization.
But as we've established, it is a textbook high-risk, high-reward scenario.
Definitely.
The analysts view this through two distinct lenses. You can view it as a short-term, highly volatile swing trade, playing the momentum heading into the joint venture closing and the DOE approval. Or you can view it as a multi-year fundamental hold, betting that they can successfully manufacture and deploy that massive 16 gigawatt-hour backlog of projects.
For you listening, situations like EOS are a perfect masterclass in market friction. It's where the harsh, incredibly messy, short-term pain of stock dilution, factory building, and cash burn goes to war with the massive long-term potential of a fundamental technological shift.
Right, the short-term versus the long-term.
The market is constantly weighing the messy reality of pouring concrete today against the pristine promise of powering the AI future tomorrow.
And, as we watch this specific company play out, I think there's a much broader lingering question we should all be considering.
Let's hear it.
We look at this incredible AI revolution, and it is entirely natural to assume that the true lasting winners will be the tech giants. The companies writing the code, building the large language models, and creating those beautiful, frictionless software curves.
The trillion-dollar household names. We all know who they are.
Exactly. But as these digital ambitions consume unprecedented, world-altering amounts of physical electricity, what if the ultimate winners of the AI boom aren't the software companies at all?
Wow.
What if the most valuable, enduring entities of the next decade are actually the unseen, unglamorous industrial companies, quietly rebuilding the foundational physical grid beneath our feet, using something as ancient and simple as zinc?
Building the future with the materials of the past, that completely flips how you look at the infrastructure around us. We'll leave you to ponder that one.